So you think that so far we're not having a true reflection of every sector of the economy in terms of the MPC when they put their figures together?
Well, substantially we are, but there are some that have been left out completely.
Let's talk about, do you think there's still liquidity squeeze in the economy, and do you think that this hike may further diminish credit creation in the economy?
If you say liquidity squeeze, that would not be consistent with what the CBN is telling us.
Okay.
CBN has said the growth of credit has been positive into the economy. But my challenge about that is the fact that CBN is comparing the growth of credit in 2011 to the corresponding period in 2010. And we all know what happened in 2010. Those were the periods of, serious move against the banks, sending a lot of jitters into the system, and banks were not lending. So if you are still comparing the growth of credit in 2011 to the growth of credit in 2010, then we are not really making a good point that the ordinary man on the street can relate to it. I think we should be comparing our 2011 with probably 2009 and 2008, and then that is when we will know that we are really having good growth. But one thing is clear: the restrictive monetary policy that the CBN wants to introduce now is going to have its own implication for the economy. And those implications are that we will be able to tame inflation. What we might pay for it, the opportunity cost might be growth, as well as the depletion of our reserves. And you can see the numbers if you look at the MPC communique.
So I'm sure you've seen the document, what this World Bank has said a few days ago about inflation in the country. Do you agree with this forecast?
Partially. I agree partially.
But the World Bank didn't say, it said from till the end of the year up until 2012, but it didn't say what quarter of 2000. Are we looking at the whole of 2012 also?
I think it will be safe, it will be prudent to assume that it's for the whole of 2012. But the fear of inflation is going to push us into increasing interest rate further. And that's going to create a lot of problems. Let me tell you what is happening in the market today. Each time you increase interest rate, you have effects in the market, in the equities market, in the bond market.
Are you saying that
the money market?
The effects, the bad effects outweigh the good effects?
You see, you need data to be able to come to that conclusion. Okay. You cannot really say at the point that you have increased the interest rate, then clearly that is when you will see the effect. No.
Okay.
But what I've seen in the last 1 week is that a lot of institutions that are going into bonds, either by way of underwriting or by way of investments, are pulling back. And this is a fact. The central bank can go into the market and confirm this. What has happened to the bond market in the last 1 year? And I know the CBN, by its MPC communique, has been increasing interest rates for the best part of this year. And I think they've increased it 4 times. You know what has happened?
This is actually the fifth
time. A lot of the bonds being traded in the market have collapsed.
You're referring to the bond yields. I know there's a relationship between bond yields and inflation.
The relationship is negative. Anytime interest rate goes up, the yield on bonds must drop.
And of course, that will make the bonds unattractive to investors.
It makes the bonds unattractive. And you have a situation in the market today where we have market makers for the bond market who are supposed to buy and sell based on a two-way quote, whatever happens. There are some bonds that you don't even have markets for at all. Nobody is buying and nobody is quoting.
Are we talking about the federal government bonds?
Even the federal government bonds.
Okay.
A lot of their bonds are not being traded. It's a disaster completely.
Both the short-term and the long-term bonds?
Yeah, but maybe some are being traded, almost like maybe 2 or 3 of them are doing well now. But the majority of the bonds are not being traded. And this is the direct effect that interest rates can have on markets. The same thing is happening to the equities market. As interest rate continues to go up, people will move their monies into the money market to capture the higher returns that they can get from the money market. And that takes money away substantially from the capital market, and you see it continues to dip. There is no rocket science about it. So all these things, they will have impacts on markets, and as they have impact on market, they will have impact on liquidity and the liquidity of the instruments themselves. In which case, your market begins to lack depth because people can hold instruments and they cannot convert it to cash. And each time that happens, it affects the wealth of individuals. It affects disposable income, and then the consumer price index will reflect it negatively. And these are the ripple effects that you will have if your policy or your strategy is to continue to increase interest rates as you get paranoid about inflation. And that's my concern. I think the CBN should sit down again and look at all these issues. The markets are getting depressed, and it's cascading.
That would look like when we're heading towards a no-win situation, because if the central bank genuinely is trying to fight inflation, as we all know, and the IMF on the other hand, or the World Bank on the other hand, is saying that inflationary trends will continue even up until 2012. And if that happens, we may, like you said, see the central bank continue to raise interest rates. At the end, it seems like we're just moving down towards some inevitable, not so happy conclusion. What can the central bank do to hedge against this?
Let me add something here. The IMF said a lot of this inflation will arise, not necessarily from what happens within the local environment, but also what will happen outside the environment of West Africa. Now, the Eurozone is troubled, America is troubled, some countries in Asia are troubled economically. The implication of that is they might be experiencing inflation. And if they do, we will be importing those inflation directly into our own economy, because we import a lot from them. We are a substantially import-dependent economy. So you are going to see a lot of imported inflation, finding its way into Nigeria. And that is part of the problem. But so much for inflation. I think what will happen is CBN has increased inflation rates. There's nothing we can do about it now, because the MPC is not going to meet again until probably November this year. I will begin to monitor the markets and the securities being traded in the markets, and let us see what the impact of this hike in inflation rates will be. Let's see the impact on lending. Let's see the impact on inflation itself.
I think we know what will happen to lending. Obviously, the banks lending to customers will go higher.
The problem is, each time they lend to customers, what kind of customers are they lending to? What kind of customers are they lending to? They are lending to customers who are taking the money to the foreign exchange market to buy foreign exchange, just to import a lot of consumption goods. And if you do that, you are increasing the marginal propensity of the economy to consume. And that also has its own implications. Now, savings rate is not growing. The CBN noted that. This is what will happen when you have a national income accounting model, which is divided into your consumption, your savings, investments, and the rest of them, and the external sector. When the marginal propensity to consume increases, the marginal propensity to invest and save decreases.